Last week, Moody's and Standard & Poor's said the U.S. risks seeing its AAA rating lowered. But this weekend, the independent Egan-Jones Ratings Co actually cut its rating for the U.S. to AA+. That is below investment grade. The company's president, Sean Egan, also telling Barron's this weekend that investors in Greek government debt will probably get only 10 cents on the dollar. He joins us right now. Sean, great to have you here.
Thank you.
A couple of stories, the U.S. and the Europe. What do you think is the more important story? I mean, you worked on them. You downgraded both over the weekend.
They're working in tandem, actually. In the case of Europe, we've been negative on it for quite some time. In the case of the U.S., we downgraded from AAA down to AA+. Still investment grade. It went down one notch. We had a negative watch since March 1st of this year.
You've been really concerned. What do you think is going to happen here in the U.S.? Let's tackle that first, since we've been talking about that a lot today. Sure. Where do you think this is going to go?
Well, the U.S. has a couple of major problems. One is that its debt to GDP is in the area of 106%. Okay, we're concerned about that.
But that's a bit different number than what we're hearing from some other folks, right? A little bit?
True, but no matter how you measure it, it's much higher than Canada's 35%.
Mm-hmm.
Okay. The other thing is you have to back up and ask the question how it got to that level. And basically, the U.S. debt has grown from $8 trillion up to $14 trillion over the past 5 years or so. And $3 trillion of it is from the wars, the three undeclared wars. $2 trillion of it is from the credit crisis, which we still haven't addressed properly. The third major concern that we have is the retirement of the baby boomers and the increase in entitlements, Social Security, Medicaid, Medicare, and the decrease in revenues. They're not going to be paying as much as in taxes in the future.
Just basic math there. But you don't see a default, do you? Not a high chance of it, at least.
There's a difference between a delinquency and a default. In other words, if the debt ceiling isn't raised, you don't really worry about the U.S. paying its debts. The bigger issue, not in the short term, certainly, it's going to take some time, but the bigger issue is whether or not they're able to reduce the debt to GDP.
I want to talk about Europe because you were profiled in Barron's over the weekend, and the thing that caught our eye, and I was talking to Jim and some others throughout Street Smart this afternoon about how you think the U.S. will ultimately help bail out European banks and government. So U.S. taxpayers once to get involved in a bailout, in your view? Well,
they're the only ones, basically, that can act quickly and enforce. The ECB has capital, that is equity capital, of about 3% of assets. And it's going south because the assets are increasing as they take on more and more of the weaker deposits for the banks, and they're buying the sovereign credit. So Europe doesn't have the ability, and there's some structural constraints in printing currency. It's really a throwback from the Weimar Republic when there was runaway of inflation. So they have their hands tied to a certain extent, and it's really the U.S. that can act, if they want to, in any sort of force. You
know, just talking with Jim Grant in terms of the European situation, he's worried about the U.S., but he says the real crisis is over in Europe. And he says ultimately maybe what you've got to do, or what needs to be done, is you've got to write down some of this debt. How are we going to see that in your view? Is it going to get to that point? It's going to have to get to that point.
There's no question. Look at Ireland. Ireland has tax revenues of about 34 billion euros. They have debt, straight debt of 200 billion euros, and they guaranteed 400. So let's say 200, multiply it by 15%. Okay, what's that? That's 30 billion, and they're only collecting 34, and then they have to make good on this other debt. So the math simply doesn't work. We argue that Greece, the amount that Greece can shoulder is significantly less than people expect.
And you do say Spain, Italy, and possibly Belgium are likely to follow Greece, Ireland, and Portugal in not being able to pay all their outstanding debt. How quickly does this unfold? We've been talking about Greece, as you know, for what, about a year and a half now.
Probably the best measure of that is the funding cost, and that look at Italy. It's it's rising very quickly. The bond vigilantes are alive and well. They just happen to be vacationing in Europe right now.
You mentioned bond vigilantes. That's right. I mean, they're not here. Does it surprise you when you look at the Treasury market?
It'll take time.
How much time?
They're watching. They're watching to see what comes out of Washington.
What do you expect, bottom line, that we're going to, in Washington, we'll meet that August 2nd deadline, and then what?
We will, and we'll muddle along. We won't decrease the debt to GDP in any sort of meaningful fashion, and then we'll be faced with the crushing blow of the baby boomers retiring, but that won't hit for several years.
Does that mean you anticipate that you'll have more downgrades on the U.S.?
We're looking at how it's going to develop, and hopefully there'll be a change. You know, you like to address some of these big problems that got us into this difficulty.
So big problems in Europe and still big problems here in the U.S.
Absolutely.
Sean, I'm going to leave it there. Thank you so much.
Thank you.
Appreciate it. Sean Egan, he's president of Egan-Jones Ratings.